In 1929, the top 10% of Americans held approximately 84% of all household wealth. 4/5 of Americans had no savings. Income growth for the bottom 90% had been flat for years while the economy appeared to boom. Consumer credit had expanded massively to fund purchases that wages could not support. A speculative bubble in financial assets had pushed valuations far beyond what reasonable expectations of future earnings could justify. The agricultural sector had been in recession for years while Wall Street celebrated, and then Congress passed the Smoot-Hawley Tariff Act, raising import duties on more than 20,000 goods, triggering global retaliation that collapsed international trade by 65% within 4 years. The combination of extreme wealth concentration, consumer debt, asset speculation, agricultural distress, and protectionist tariffs transformed what might have been an ordinary recession into the worst economic catastrophe in modern history. GDP fell 30%, industrial production fell 47%, unemployment reached 25%. 9,000 out of 25,000 banks went out of business. The broad money supply contracted by nearly a third, and the suffering lasted a decade. I want you to hold that sequence of conditions in your mind. Extreme wealth inequality, flat income growth for the bottom 90%, widespread consumer debt, asset speculation at historic valuations, agricultural distress, protectionist tariffs triggering global trade collapse, a Federal Reserve that made catastrophic policy errors. And now I want you to compare it to what exists in the United States of America in April of 2026. Because the parallels are not vague, they are not metaphorical. They are specific, measurable, and in several critical dimensions worse than the conditions that preceded 1929. And 2 days ago, the International Monetary Fund warned that the world may be headed for a global recession. And nobody in a position of authority is willing to say the word that the data is pointing toward. So I am going to say it. And I'm going to show you why the next 90 days will determine whether what is coming is a recession or something far deeper and far more destructive than anything this country has experienced in nearly a century. The wealth inequality is now at levels not seen since 1929, and the consumer is more depleted than at any point in modern history. The top 0.1% of Americans now control more than 20% of all U.S. wealth, a concentration level that matches the pre-Depression peak. The wealth gap has returned to levels unseen since before World War II, according to the Washington Center for Equitable Growth. Brookings Institution has specifically asked whether rising inequality has brought us back to the 1920s, and the answer, based on the data, is yes. Income growth for the bottom 90% has been nearly flat for years, while household wealth among the top 10% has ballooned. In the 1920s, this concentration created a fragile economy where too much capital was trapped in speculation instead of circulation. When the speculative bubble popped, the consumer base was too weak to sustain demand, and the economy collapsed into a self-reinforcing downward spiral. The same structural fragility exists today, but with an additional dimension that did not exist in 1929. In 1929, 4/5 of Americans had no savings. In 2026, McKinsey documented that 29% of adults dipped into their savings in just the last 3 months, 29% reduced their savings rate, and 28% are using credit cards more. Credit card delinquency rates have climbed to the highest in almost a decade. Auto repossessions hit the highest since the 2008 financial crisis. Student loan delinquencies are rising at record pace. And the Century Foundation found that 1 in 3 Americans, 34%, skipped a meal in the past year due to cost, up from 1 in 4 just months earlier. The American consumer in 2026 is not just unequal. The American consumer is depleted. The savings that were supposed to provide a buffer against economic shock have been consumed by 6 years of cumulative inflation that raised prices 26% while wages gained barely enough to keep pace. Rents are up 36% since January 2020, according to Zillow. Home prices are up 81% since 2017, according to the Urban Institute. Auto insurance is up 55% since the pandemic. Daycare is up 39% since 2019. Health insurance premiums for employer-sponsored coverage have risen 342% since 2000, more than 5 times the rate of economy-wide inflation, according to Brookings. The ACA subsidy expiration pushed premiums from $888 to $1,904 for qualifying households, according to KFF. And 3 in 10 Americans delayed or skipped medical care in the past year due to cost. Roughly two-thirds switched to cheaper groceries or bought less food entirely. Working-class Americans are twice as likely to take out payday loans and significantly more likely to use buy now, pay later to cover everyday expenses. In the 1920s, the expansion of consumer credit that masked the underlying inequality was primarily installment buying of automobiles and appliances. In the 2020s, the consumer credit expansion that masks the inequality includes $1.21 trillion in credit card debt at an average APR of 22.76%, $1.6 trillion in student loan debt, $1.6 trillion in auto loan debt, and a rapidly growing BNPL market that is now being used to finance groceries. The total household debt load relative to income is comparable to 1929. The difference is that in 1929, the debt was concentrated in stock margin loans and installment plans that could be deflated away. In 2026, the debt is concentrated in non-dischargeable student loans, high-interest revolving credit, and housing costs that are structurally embedded at permanently higher levels. The consumer is not overextended temporarily. The consumer is overextended structurally. And the consumer sentiment reading from the University of Michigan survey, 47.6 in early April, is the lowest in the entire 75-year history of the index. Lower than during any previous recession, lower than during the 2008 financial crisis, lower than during the pandemic, lower than during the 1970s stagflation that most closely resembles the current environment. The consumer, who was the engine of the American economy for 80 years, is running on empty, and the 90 days ahead will add energy cost increases from the Iran war, food cost increases from the supply chain cascade, potential tariff reimposition, and a debt ceiling crisis on top of a consumer base that has already exhausted its reserves. And there is a structural parallel between 1929 and 2026 that economic historians have identified, but that has received almost no mainstream attention. Before the Great Depression, the United States was undergoing a massive sectoral transition from agriculture to manufacturing. The agricultural sector had been in recession for most of the 1920s while urban manufacturing boomed. The shift displaced millions of workers who could not transition their skills from farming to factory work fast enough. Academic research published in Science Direct specifically noted that the shift from farming to manufacturing before the Great Depression has parallels with the sectoral shift occurring today. In 2026, the transition is from manufacturing and knowledge work to artificial intelligence automation. Goldman Sachs estimates that 16,000 jobs are being displaced by AI every month. Stanford's economic analysis noted that the labor market is in a low-hire, low-fire equilibrium where companies are not laying off in waves but are simply not replacing workers who leave because the work is being automated or restructured. Nearly 90% of net private job creation is in healthcare, a sector that is itself facing $1 trillion in Medicaid cuts over the next decade. The workers being displaced by AI in 2026, the mid-career professionals in accounting, legal research, content creation, customer service, data analysis, and administrative functions, are the equivalent of the farmers being displaced by mechanization in the 1920s. They have skills that are becoming obsolete faster than new skills can be acquired. They are concentrated in the income brackets that drive consumer spending, and their displacement is happening silently because companies are not announcing layoffs. They are simply freezing hiring, automating tasks, and allowing attrition to reduce headcount. The unemployment rate does not capture this. The GDP numbers do not capture it. The only places it shows up are in the payroll growth data, which is narrowed to a single sector, in the consumer sentiment data, which is at a record low, and in the savings depletion data, which shows Americans drawing down reserves at an accelerating rate. The Great Depression was preceded by a structural labor transition that left millions of workers stranded between an old economy and a new one. The same transition is happening now, and the workers caught in the middle have no safety net because the safety net is itself being cut. Medicaid, SNAP, ACA subsidies, all reduced or eliminated at the exact moment the labor market is failing to absorb the workers it is discarding. The tariff parallel to Smoot-Hawley is not a metaphor anymore, and historians are saying it out loud. The Smoot-Hawley Tariff Act of 1930 is considered by the U.S. Senate's own historical documentation to be among the most catastrophic acts in congressional history. It raised the average ad valorem rate on dutiable imports from 25.9% to 50%. It triggered retaliatory tariffs from every major trading partner. International trade collapsed by 65% between 1929 and 1934. American exports fell from $5.2 billion in 1929 to $1.7 billion in 1933. The consensus among economists and economic historians, including Keynesians, monetarists, and Austrian economists, is that Smoot-Hawley worsened the Depression by seriously reducing international trade. And the parallels to Trump's tariff regime are no longer theoretical. They are being drawn explicitly by historians and economists. Anadolu Agency published an analysis titled __quote_0_Vox EU, the policy arm of the Center for Economic Policy Research, published analysis calling Trump's tariffs fiscal folly, and the numbers confirm the comparison. U.S. customs duties tripled from $97 billion annualized in Q1 2025 to $331 billion by Q3 2025, according to Purdue University's analysis of federal revenue data. That is a threefold increase in the tariff burden in 6 months, and Treasury Secretary Bessent suggested 2 days ago that tariffs could be reinstated as early as July 2026 after being partially paused during the Iran crisis. The tariff drag on GDP growth was nearly 1% in 2025, according to RSM. That was with tariffs at their initial levels. If they are reimposed at higher rates while the economy is simultaneously absorbing an energy shock from the Iran war, a government shutdown, record low consumer sentiment, and rising inflation, the combined effect is not additive. It is multiplicative, because each pressure weakens the economy's ability to absorb the next pressure. Smoot-Hawley did not cause the Great Depression. It turned a recession into a depression by destroying the trade relationships that could have provided a pathway out. Trump's tariffs, reimposed on top of an energy crisis and a consumer depletion that already exceeds anything seen since the pandemic, risk performing exactly the same function, taking a downturn that might have been manageable and making it catastrophic by closing off the economic valves that would otherwise allow pressure to escape. And the global context amplifies the comparison. In 1929, the United States was the engine of global growth, and its tariff policy destroyed the trade relationships that sustained the world economy. In 2026, the United States remains the engine of global consumption, but the global trade architecture is already fractured by 2 years of tariff escalation, the Iran war, Red Sea disruptions, and Strait of Hormuz closure. The IMF warned on April 15th that renewed trade tensions could significantly weaken growth and destabilize financial markets. They issued that warning on the same day that Treasury Secretary Bessent suggested tariffs could be reinstated as early as July. The IMF and the U.S. Treasury Secretary are issuing directly contradictory signals within the same 24-hour news cycle. The IMF is saying, do not reimpose tariffs. The Treasury Secretary is saying we might reimpose tariffs. And the global economy, already reeling from a war that the IEA called the greatest energy security challenge in history, is being asked to absorb a potential second trade shock on top of the first energy shock, while consumer sentiment in the world's largest economy sits at the lowest level ever recorded. In 1930, Smoot-Hawley was passed during a recession that had already begun but had not yet become a depression. The tariff was the accelerant that turned the fire into a conflagration. In July 2026, if tariffs are reimposed during an energy crisis, a consumer depletion, a banking liquidity stress, a debt ceiling standoff, and a Fed leadership vacuum, the accelerant will be applied to a fire that is already burning from 5 directions simultaneously. In 1929, America was the world's largest creditor nation, and today America is the world's largest debtor nation, and that changes everything. This is the single most important structural difference between 1929 and 2026, and it is the reason that the next depression, if it comes, would be worse than 1929. In 1929, the United States was the world's largest creditor nation. America had lent substantial amounts to Europe and the United Kingdom to help rebuild after World War I. When the crisis hit, America called in those loans, which devastated European economies but preserved American financial capacity to eventually recover. The United States had leverage. It was owed money. It could draw on foreign obligations to fund domestic recovery. In 2026, the United States is the world's largest debtor nation. The U.S. net international investment position, the difference between what Americans own abroad and what foreigners own in America, is at its most negative level relative to GDP in the nation's entire history. Not during the Great Depression. Not during the Great Recession. Never. The national debt has reached 100% of GDP. Interest payments on that debt have crossed $1 trillion per year for the first time, exceeding the entire defense budget. The federal deficit is running at $1.05 trillion and climbing. Foreign holdings of U.S. Treasury securities, while still massive, are declining. China has reduced its Treasury holdings from $1.3 trillion in 2013 to approximately $760 billion. Central banks globally are diversifying reserves away from the dollar, and the country's three credit rating agencies have all downgraded the United States from AAA, citing unsustainable fiscal trajectories that no administration from either party has addressed. When the Great Depression hit in 1929, America was the banker to the world. It could afford to make policy mistakes because it had a financial cushion of foreign assets and incoming loan repayments. In 2026, America is the borrower from the world. It cannot afford policy mistakes because every mistake increases the cost of the borrowing that the entire federal budget depends on. A recession in 1929 was devastating because of the domestic cascade. A recession in 2026 would be devastating because of the domestic cascade, plus the international financing crisis that would erupt the moment foreign creditors questioned America's ability to service its debt. That questioning is already happening. The credit downgrades are a public form of it. The dollar's declining reserve share is a market form of it. And gold crossing $4,500 per ounce, roughly triple its price from just a few years ago, is the most primal form of it. The world's central banks are buying the one asset that does not depend on any government's promise to pay. And there is one more dimension that makes 2026 structurally worse than 1929 in terms of the speed at which a crisis can cascade. In 1929, a bank run required depositors to physically line up outside the bank and demand their money. The process took hours or days. Bank management could see the line forming and attempt to secure emergency funds. The government could observe the crisis developing and intervene. In 2026, a bank run happens on a smartphone. Silicon Valley Bank lost $42 billion in deposits in a single day through electronic transfers. No line, no warning, no time for intervention. The deposits left faster than any physical bank run in the history of banking. And the social media dynamics that amplified the SVB panic, where venture capitalists tweeted warnings that went viral within hours, would operate at the same speed during any future banking stress. The FDIC insurance limit of $250,000 means that every depositor with more than that amount at a single institution has a rational incentive to move their money at the first sign of trouble. And in a digital banking system, moving your money takes 30 seconds. Not 30 minutes, not 30 hours. 30 seconds. The speed of a modern bank run is incompatible with the speed of the regulatory response. By the time the FDIC can assess the situation, declare an emergency, and extend guarantees, trillions of dollars can have already moved. That speed differential is what makes the current banking vulnerability more dangerous than 1929, not less. The tools are better, the safety nets are wider, but the velocity of the crisis has outpaced the velocity of the response. 9,000 banks failed in the Great Depression, and today's banks are holding trillions in unrealized losses while the Fed pumps $500 billion in emergency cash. Between 1929 and 1933, approximately 9,000 of America's 25,000 banks went out of business. The broad money supply contracted by nearly a third as deposits were destroyed. The bank failures created a vicious cycle where lost deposits reduced spending caused business failures caused more bank losses, and more bank losses caused more bank failures. The Federal Reserve's catastrophic error during the Great Depression was failing to act as lender of last resort and allowing the banking system to collapse. Ben Bernanke himself, as Fed chair during the 2008 crisis, publicly acknowledged this by saying, quote, "The question in 2026 is whether the Fed is capable of preventing a banking crisis when its own independence is being dismantled, when it is operating at a cumulative loss exceeding $200 billion, when bank reserves have fallen from $3.3 trillion to $2.8 trillion, and when the New York Fed has been quietly pumping nearly $500 billion into the banking system through the standing repo facility since October 2025. Those cash infusions are the modern equivalent of lender of last resort operations. They exist because banks do not have the liquid cash on hand to meet their obligations without Fed support. The cap on those operations has been removed. There is no limit on how much the Fed can inject, and the names of the banks receiving the emergency cash will not be disclosed for 2 years under Dodd-Frank's delayed disclosure rules. Silicon Valley Bank failed in March 2023, and depositors lost access to their funds in a matter of hours. The contagion spread within days. Signature Bank and First Republic Bank followed. And the government's response, extending emergency guarantees beyond the FDIC limit, was a discretionary intervention with no legal guarantee it would be repeated. Today, the FDIC insurance limit remains at $250,000, unchanged since 2010, eroded by 31% in real terms, and the banking system is holding trillions of dollars in unrealized losses on Treasury securities and mortgage-backed securities that were purchased at low rates and are now underwater at current market rates. If those losses were realized, dozens of regional banks would be technically insolvent. The only reason they are not insolvent is that accounting rules allow them to hold the securities at cost rather than market value. But if depositors withdraw funds, forcing those securities to be sold, the losses crystallize. That is exactly what happened at Silicon Valley Bank. And the conditions that created SVB's vulnerability, rising rates combined with long-duration bond holdings, exist at hundreds of banks across the country right now. The FDIC's own problem bank list has been growing, and the $500 billion Fed emergency cash program is the silent admission that the banking system's liquidity position is more fragile than anyone in authority is willing to say out loud. The Fed made the catastrophic error in 1929 by being too tight, and the Fed is making the same error in 2026, but for the opposite reason. In 1929, the Federal Reserve raised interest rates to cool stock market speculation. The higher rates depressed interest-sensitive spending in construction and automobile purchases, which reduced production and contributed to the initial downturn. Then, as the banking system began to fail, the Fed failed to expand the money supply, failed to act as lender of last resort, and allowed the monetary contraction to transform a recession into a depression. The consensus among economists, stated explicitly by Ben Bernanke, is that the Fed's passivity was the critical error that turned a manageable downturn into a catastrophe. In 2026, the Fed faces the inverse problem. Inflation is rising at 3.3% annually, driven by the Iran war energy shock and the structural cost of living crisis that preceded it. The Fed cannot cut rates to support the weakening economy without risking a 1970s-style entrenchment of inflation. But the Fed cannot hold rates at current levels without exacerbating the consumer depletion, the mortgage crisis, the credit card crisis, and the business investment slowdown that are already visible in the data. The 1929 error was passivity in the face of deflation. The 2026 error is paralysis in the face of stagflation. Both errors have the same root cause. The Fed is trapped by circumstances that leave no good policy options. Cut rates and inflation accelerates. Hold rates and the economy contracts. Raise rates and the consumer collapses. The policy toolkit that saved the economy in 2008, massive rate cuts combined with quantitative easing, is unavailable now because inflation is too high for rate cuts and the Fed's balance sheet is already bloated and generating operating losses. And the political capture of the Fed through the Powell replacement process adds a dimension that did not exist during any previous crisis. If the new Fed chair cuts rates under political pressure rather than economic justification, the dollar weakens, import prices rise, inflation accelerates, and the credibility of the institution that is supposed to manage the currency is destroyed. 3 former Fed chairs have already warned that this is how monetary policy is made in emerging markets with weak institutions. The United States is being governed like a country whose institutions are failing, and the institutions that are supposed to prevent a depression, the Fed, the Treasury, the regulatory apparatus, are either captured, depleted, or paralyzed by the convergence of pressures that the next 90 days will bring. The IMF just warned of global recession 2 days ago, and their baseline scenario is already more optimistic than reality. On April 15, 2026, the International Monetary Fund released its World Economic Outlook and cut global growth to 3.1%. Their chief economist, Pierre-Olivier Gouronchas, said at the spring meetings that despite major trade disruptions and policy uncertainty, 2025 ended on an upbeat note, but now war in the Middle East has halted this momentum. The IMF specifically warned that a longer or broader conflict, worsening geopolitical fragmentation, a reassessment of AI-driven productivity expectations, or renewed trade tensions could significantly weaken growth and destabilize financial markets. Every single one of those risk factors is either currently present or imminent in the data as of April 17, 2026. The conflict is not short-lived. The ceasefire collapsed. The Islamabad talks failed. Trump declared a naval blockade. The strait remains blocked. Geopolitical fragmentation is worsening as Iran attempts to institutionalize control of the Hormuz choke point. AI productivity expectations are being reassessed as energy costs from the war threaten data center economics. And tariff reimposition was suggested for July by the Treasury Secretary himself. The IMF's baseline forecast assumes oil averaging $82 per barrel across 2026. Oil is currently above $95 and was above $120 during the fighting. Their baseline is fantasy. Their downside scenario, which projects potential contraction, is now closer to reality than their published forecast. And the IMF reduced the U.S. growth outlook by 0.1 percentage points to 2.3%. That reduction was calculated before the ceasefire collapsed and before the tariff reimposition was suggested. The actual trajectory is worse. The conference board projected that even if diplomacy prevails, the negative shock to the economy is already set in motion and spillovers will extend into the second half of the year. Deloitte expects the Fed to hold rates steady until December because of the inflation surge. RSM assigns a 30% recession probability calculated before the latest escalation. And Stanford described the current labor market as a low-hire, low-fire equilibrium where companies are not laying off workers but are simply not hiring, and nearly 90% of private job creation is in a single sector. Strip that one sector out and the American private economy has stopped generating employment. That is not a recession in the technical sense. It is something potentially worse. It is an economy that is simultaneously producing positive GDP and negative opportunity. Growing on paper. Shrinking in practice. The gap between the official statistics and the lived reality of the American household has never been wider, and the 90 days ahead will either close that gap through a statistical downturn that finally forces the official numbers to match the reality, or widen it further through policy interventions that temporarily prop up GDP while the consumer base continues to deteriorate beneath the surface. Either outcome is dangerous. And neither outcome is something the American public has been prepared for by anyone in a position of authority. Because the word depression is a word that nobody in Washington will say. Not because the conditions do not warrant it, because saying it would make the financial markets react in ways that no one is prepared to manage. And so the word goes unsaid. While the conditions that define it accumulate, deadline by deadline, data point by data point, through the 90 days that are about to unfold. And the people who will bear the weight of whatever comes next are the same people who bore the weight of every previous American economic catastrophe. The workers, the retirees, the families, the small business owners, the people who did not create the debt, did not design the tariffs, did not start the war, did not capture the Federal Reserve, did not speculate in financial markets, and did not benefit from the tax cuts that added $3 trillion to the deficit. They are the people standing in line at the gas pump at $4.15 per gallon. They are the people in the grocery store watching prices rise 21% on gasoline and 15% on beef in a single year. They are the 34% who skipped a meal. They are the 29% who delayed medical care. They are the parents who cannot afford childcare. They are the 62-year-olds who cannot find employment because the labor market does not want them and the government is about to take away their food assistance for failing to document 80 hours of work they cannot find. In 1929, 25% of the American workforce was unemployed at the peak of the Depression. The suffering lasted a decade. The recovery required World War II, and the Americans who lived through it never forgot what it felt like. The question that the next 90 days will answer is whether the Americans alive today are about to learn that feeling for themselves. Not because the stock market crashed, but because every system that was supposed to prevent it, the Fed, the Treasury, the safety net, the trade architecture, the fiscal discipline, the institutional credibility, was dismantled, depleted, captured, or broken before the crisis arrived. The crash of 1929 was a failure of markets. What is coming in 2026, if it comes, will be a failure of institutions. And institutional failures do not recover in quarters, they recover in generations, if they recover at all.